Absa has named Kenny Fihla as the group CEO. He will take up the reins at the bank on the 17th of June. That's as Fihla has resigned from Standard Bank as the firm's deputy CEO and CEO of Standard Bank South Africa. His last day in office there will be the 13th of June, and Standard Bank says the necessary succession planning measures will be announced in due course. Fihla's appointment is subject to regulatory approval. MTN has had a difficult year. The mobile network operator had to contend with foreign exchange devaluation, particularly in the Naira. Conflict in Sudan also weighed on the firm during the period. And as a result of those two factors, headline earnings per share fell 69%. CEO Ralph Mupita says despite the challenges in the operating environment, MTN delivered a strong underlying performance. A dividend per share of R3.45 has been declared. That's an increase of 4.5%. Solid, that's how Sun International has described its full-year performance. The hotels and gaming group has reported a 17.4% rise in headline earnings per share. This was supported by growth at the group's SunBet business. Income from that division jumped over 60%, once again exceeding growth targets. A final dividend of R2.37 has been declared. This takes the total for the year to just under R4. Lower coal prices have weighed on Thungela. The fossil fuel miner has posted a 29% decline in full-year profit. Thermal coal prices remained soft during the year due to subdued demand in Europe, where milder winter conditions resulted in high coal and gas stock levels. Given the performance, the firm has cut its payout to shareholders. A dividend of R11 per share has been declared. This takes the total to R13, which is down from R20 in the previous period. Hulamin has reported a 28% slump in full-year headline earnings per share. That's largely due to operational challenges and a fire at the Can End fishing line. This dampened the aluminium group's ability to fully take advantage of a recovery in demand that it noted in the second half. And RFG has noted a 2.1% rise in revenue for the 5 months to end February. That's thanks to a strong recovery in the group's regional segment. That division benefited from higher volumes in both fresh and long-life foods, despite consumer spending remaining under pressure. But the owner of Bull Brand says its international segment struggled during the period. That unit was impacted by declining demand and shifting market dynamics. This led to a large number of canned deciduous fruit contracts not being honored by customers, and these orders then had to be redirected to alternative markets where they were sold at lower prices. More detail will be available in the company's financial results, which are due to be released on the 21st of May. In international news, China's retail sales growth quickened in the January and February period, in a welcome sign for policymakers' efforts to boost domestic consumption. This even as joblessness arose and factory output eased, underscoring the strains on an economy facing fresh U.S. trade pressure. Here's more detail in this report.
China's government received a welcome local economic update despite growing trade tensions with the US. Official data released Monday showed retail sales growth sped up 4% in January to February. It's better news for policymakers as they try to boost domestic consumption. It improved on December's 3.7% rise and was in line with analyst expectations. Household consumption in the first 2 months was helped by holiday spending during the 8-day Lunar New Year holidays. Policymakers have made expanding domestic demand a top priority this year. They want it to cushion the impact of Washington's tariffs on its crucial export engine. Chinese leaders have also kept an economic growth target of around 5% for this year. But analysts say that may be hard to achieve given pressure on exports, weak household demand and a long-running property crisis. The pressure on China's economy came through as data showed joblessness rose and factory output eased. The urban survey-based jobless rate rose to 5.4% in February, its highest in 2 years. Monday's data also followed weaker than expected exports and inflation indicators earlier this month. Analysts said those updates showed the need for more policy support to build a sustainable economic recovery. It all comes while US President Donald Trump has put a further 20% of tariffs on all Chinese goods and has threatened more action.
And Tesla will make a lower-cost version of its best-selling Model Y in Shanghai, aiming to regain ground lost during a price war in its second-largest market. Let's take a look for more detail.
Tesla is planning a cheaper version of its best-selling car. Reuters sources say the firm will make a new variant of the Model Y crossover at its plant in Shanghai. The car will reportedly be smaller and cost at least 20% less to produce. The sources say most of the output from Shanghai will be sold in China, where Tesla faces a battle to retain market share. They add that mass production will begin next year, with output in Europe and North America to follow later. There was no comment from the firm on the report. Tesla chief Elon Musk said in January that his company would introduce cheaper models in the first half of the year, but he didn't give any details on the pricing or size of any new vehicles. Last year, Reuters reported that Tesla had dropped plans for a new lower-cost car, often dubbed the Model 2. Musk called those reports a lie, without offering any evidence. Now a new launch would come amid ever-mounting competition in China. The Model Y was the country's best-selling car for the past 2 years, but local rivals like BYD have been grabbing market share. Tesla also faces a fierce new challenger in Xiaomi, better known as a phone maker. Its first car, the SU7 sedan, has been outselling Tesla's competing Model 3 since December.